Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
Hello,
Hey,
Bruce.
happy Monday. We got a lot to cover today, my friend.
Looks like you rearranged your. Yeah, man. Let's
working
do
on
it.
it.
You know, Yeah, I see that. So, I'm anticipating a drop in mortgage rates, credit rates across the board, right? Over the next couple months, I think we're going to start seeing some better impacts of that. And so, in that spirit, I wanted to prepare some people that might be on the fence with their credit, because that way they can get ready while we're still sitting here at 6%, right? So I got a couple charts. Let's go ahead and show these real quick.
All right, these are our algorithms for credit.
Right, exactly. So I think this is something that a lot of people misunderstand or misinterpret. They worry about things like pulling their credit, like it's going to have a major impact on them. And they worry about things like closing accounts, right? Which is actually, believe it or not, a bad thing, right? So I just kind of wanted to go through this with you, because people think it's this big mystery, and it kind of was for a while, like how scores work. But this is kind of the magic right there, right?
Well, it obviously is. You can see that you have 65% of your credit is in payment history and credit utilization. But then you got 15%
That's exactly
in
right.
length of credit history. So I think we can break these down.
Yeah. So I've got the 6 tips to help people improve their credit score, right?
All right. So let's cover these then. Well, I think the first one goes without saying, doesn't it?
You would think that would be the case, but apparently a lot of people don't think it's that important.
Very important. Let's just put that at the top.
It's
at the top of the
35%.
list. If you don't pay your bills on time, you're not going to have a good credit score. Period.
It is 35% right there, right?
So reduce credit card balances. Everyone should be under 30%. You should never charge over 30%. If you have $1,000 limit, 300 should be your max. Don't go to 301. It starts to tank your credit. And 30% is
That's
really, the gold standard for staying under that limit. But if you're less than 30% is even better.
As I understand it, 10% is the diamond limit, right? I mean, so if you can stay under 10% utilization, that's even better than 30 by a long shot.
And we have tips for building credit versus maintaining good credit. They're different. So we'll go into that a little bit. Avoid opening new credit accounts. Every time you go into a store and they say you get 10% off if you sign up for this credit card, you are hurting your credit. When you're shopping for a car, if that dealership sends you to multiple different banks, they're all pulling your credit. It can hurt your credit. Now, typically an inquiry with a mortgage is not going to hurt your credit. And then pay off debt strategically. People don't know what that means, but if you're overloaded with debt, have you ever tried to pay a little extra on a bunch of different cards and they don't seem to go anywhere? Start with the account with the lowest balance. Forget about the interest rates on each one. You got a 10,000, a 5,000, a 3,000, a 1,000, a 500, and a 200. Pay the 200 off. Then take the money you were paying for the 200 and the $500 balance and work on paying that off in 2 or 3 payments. Then go to the next one and then the next one. Climb the ladder, smallest to biggest. You'll get more results.
A lot of people call that a debt snowball, right? Because as you pay off the debt, you take what you were paying for the minimum payment on the debt that you just paid off and apply it to the other ones, right? So it builds over time and actually goes faster.
Absolutely, it does.
Yeah,
check your credit report for errors. So you can go to annualcreditreport.com and it's a free service. I don't like people doing Credit Karma or any of those other services. The reason for that is, how much does Credit Karma charge you? They don't charge anything. And guess what? When they don't charge you anything, you become the product. So they're selling your data off to other companies. So you think you're getting something for free, but you're really getting it. You're not getting anything for free.
Well, now to be fair, annualcreditreport.com is free as well, but it was
that's why.
Well, it was required that the credit company, Equifax, TransUnion, and Experian, right, that they provide you with one per year. So here's what I do, just to let you know. Every 4 months, I pull one of my reports. So because I want to pull them often, right? And usually stuff that shows up on one shows up on all the others. So I pull one every 4 months and review it. That way I'm always checking my credit.
And then the last one is keep old accounts open. The older the account, the better it helps you build your credit. Now, that means obviously you have to be paying it on time. However, old accounts, even if it had a 25% interest rate, keep a small balance on it. Keep $5 on it so it stays open, because that's going to give you the best possible credit. So then I've got some additional tips here.
Well, these are things to not do.
Common mistakes that people make, okay? Trying to fix your own credit yourself. Yeah. You will do more damage than good. On the other hand, I'm not advocating going to a credit repair company. I think that most of them are scammers. They take your money, and all they do is dispute everything on your credit report. You think your score goes up, and then nobody will loan you any money because everything's disputed. Now, remember, when you dispute an account, Tom, it removes that negative credit from the credit reporting. So you're getting a false credit score. All right.
Okay. Yeah. So it would now at some point, disputing an account that is bad will eventually actually go away, right? Or not
go away, provided that you can prove empirical data that it is erroneous. Now, if it's truly not something, if you look at it and go, I paid that apartment complex, I know they did, you then go back, find the bill, find your receipt, find your check, and then you can dispute it. But if you just I hate that company, I'm just going to dispute it, then it's going to hurt you more than it's going to hurt them. Paying off collections.
Cool.
Okay. Listen, we are very strategic in our business that we don't want people paying off old collections. Now, deleting a collection is different than paying it and showing it paid and resolved. When we look at collections, we want to instruct you how to get them deleted from the report, because that's going to raise your score much better than actually just paying it. Paying it's going to show a satisfied derogatory account, but it might even hurt your credit worse before it gets better. Don't ever make installment payments on a derogatory account. Every month when you make that payment, it's in arrears. So they're going to show it in arrears on a regular basis, and that makes your credit even worse. Don't do it. Okay. We talked about opening and closing new cards already. So keep old cards open. Don't open store cards just to get a discount. It's not worth it. Believe me, it's not worth it. And then paying credit cards to zero. So if you already have a credit score close to 800 and you want to pay your cards to zero, then fine and dandy. But if you're trying to build credit, you want to pay them down to about $5, because that way the creditor will still report to the bureau, but it shows that you have a lot of utilization remaining and that there actually is something to report. But when it's zero, that creditor doesn't have to report, and you don't get the benefit of having a zero.
Gotcha.
And then we talked about keeping old accounts open.
Yeah.
Keep those accounts open no matter what. They're good for you. We run credit analyzers so we know exactly what to pay and how much to pay it down. You don't know that. I actually play when I'm going on my credit analyzer, I will work it down to the dollar on how much has to be paid off. And some accounts are going to give you big benefits and some accounts won't give you any benefit.
I know. We've worked on that a few times with a few people that we were trying to get approved, and magically you got them approved. So that's some great advice, man. Hey, listen. So being prepared to jump in this market, I'm anticipating mortgage rates going down. Do you agree?
I think they've already come down. I don't think we're going to see much of a drop after the Fed does cut rates. It's now a 50-50 change.
No, I'm talking about by the end of the year and into the first quarter.
I do think that there is a definite potential. I don't think we're up for a decrease on the November meeting, but probably following, because if they do a 0.5 point cut September 18th, it's going to take 3 months for that to really take effect anyway.
Yep. Well, I want people that aren't ready, that are just like giving up, because I talk to a lot of people that are like, oh, I'll never buy a house. Rates are too high. I might as well spend my money and buy this or buy that and whatever. And I'm like, no, man, stay the course. It's, you just got to improve your credit a little bit and be prepared to jump on it when the mortgage rates are So, hey, bud, listen, we both got to go. It's been a great 10 minutes, 11 minutes. You have a great rest of your day and rest of your week.
We can help you. Tom and I can help you in all 50 states. Watch us on Spotify, or listen to us on Spotify, iHeartRadio. Watch our YouTube channel and check out social media. If you have questions regarding financing or homes, feel free to give Tom or I a call. We're always here to help.